Last year was one of the worst years on record for all assets. The 60-40 portfolio, for example. And I think people are still a bit scarred from that. But also, a lot of people want their comeuppance. They want their 50% crash. We had technology was down 70%, but the S&P and the NASDAQ, they were down kind of 30, 40%. Decent-sized recessions, much like 1990 recession, nothing out of the ordinary, and they're showing the recovery. And yes, we understand that inflation is going to keep coming down lower. We understand that the ISM is showing negative GDP. We think there is negative GDP on the cards, but all the forward-looking stuff is saying we've got a recovery coming, and that's what the markets have been pricing.
Also, just before we go any further, this channel has a daily giveaway of 1 million Shiba tokens. To enter, all you have to do is be subscribed to this channel, like this video, and comment hashtag Shiba Inu. Good luck. In a year marked by unprecedented economic turbulence, the very fabric of asset management and economic forecasting has been put to the test. Dive into this candid interview, where our expert dissects the tumultuous landscape of 2023, shedding light on the dramatic downturns in technology, the S&P, and the NASDAQ. With a keen eye on the horizon, he offers a glimmer of hope, suggesting that forward-looking indicators hint at an impending recovery. But as the world grapples with a slow economy, rising unemployment, and falling inflation, what role will the Federal Reserve play in the unfolding drama? Discover the intricate dance of monetary policies, the looming specter of deflation, and the strategic moves central banks might employ to debase currency and manage mounting debts. Strap in for a deep dive into the economic currents that will shape the world's financial future.
The other thing is this recession idea, right? It's like, we're going to go into recession and therefore we're going to see a collapse. And really, what we're looking at is stuff that was already priced in again. So if we look at like imports and exports, we're seeing world trade falling. So here's the Eurozone imports from non-Eurozone countries, right? Collapsed. We've seen that everywhere. We know this information. This information was essentially that fall in the ISM. There's nothing new to know here. Yes, economic growth is incredibly slow right now. Yes, many countries are in a recession. Yes, some will avoid a recession. I do think the US is in a recession now, and it's a mild one. But that's what we see from this stuff. Also, if there's a recession, you see jobs falling. So here's job openings. Now, job openings are coming off sharply, and they will continue to come off until they get back to some sort of trend. That shows you we're in the recessionary environment. We know this. It's been priced in. Also, non-farm payrolls. Everyone frets over this bloody stuff every month, and really the forward-looking indicators have been calling it all along. It's going lower. Just takes time. These things are lagged, if you remember. Wages lag ISM, and they will eventually keep falling, and then we'll start getting negative prints, and people will suddenly wake up and smell the coffee, much like we've seen with the unemployment rate. It's like, oh, it's ticking up now. So it does come, but it takes time. And by the time non-farm payrolls are negative and inflation is below 2%, well, the market's well looked through this, and it's looking for the recovery. But it also means that the cowbell, the monetary stimulus, the printing, and even the ability in an election year to add fiscal stimulus grows. And I think they want that. I think they want the excuse to stimulate. And I'll come on to why, but the election side of the cycle, of course they do. They always do. Politicians just want to hit the print button, give you money, vote for me. That's the way the world works, sadly. So the unemployment rate. So this is an inverted unemployment rate. So as this goes down, unemployment rate rises. Our GMI unemployment index leads by 3 months. It's suggesting unemployment is going to rise about 1% from the low. So we're starting to see that happening. So unemployment should start ticking up. Now, if unemployment's rising and inflation is falling, ding, 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 more cowbell. More cowbell, yield curve, interest rates start falling. Remember the financial conditions index? The dollar starts weakening. And what we get at that point is the financial conditions index showing further loosening, and that drives the next leg of a bull market. So I think the market continues into the end of this year. Then it might have a soft patch as the financial conditions index, which is forward looking, slows stuff down. And then from the cowbell, we'll see it going forwards. I'm not focused on the volatility part. I'm in this cycle for the full cycle. which I think goes into 2025, maybe even to 2026. So it's kind of, for me, as you strap in and ride the trend. And I'll talk about what assets in a bit.
CEO confidence is a crucial barometer for the economic climate. When the leaders at the helm of major corporations are optimistic, it often signals a positive trajectory for the broader market. Despite the challenges, many CEOs are beginning to see the light at the end of the tunnel. But it's not just about the present, it's about understanding the patterns and trends that have led us here. The recurring theme? The market's ability to price in future events. As we approach an election year, the potential for fiscal stimulus grows, and this could be the catalyst for further market growth. But how long can this trend continue? Let's explore further.
The other thing to know about unemployment rate is every time it rises by 0.5% from the low, the Fed cuts. Every single time since about 1950. Now, you might say, but unemployment is crazy low right now. And that's true, but it doesn't necessarily lead to wage rises or ongoing wage rises. Japan has had very low unemployment. In fact, for the last 10 years, got a 10-year older population. It's had unemployment at 3.5% or lower, basically, barring a couple of recessions, for extended periods of time. And that's because as their older population leaves the workforce, the younger population has jobs, but they have to compete against friendshoring, offshoring, and technology. So wages over time still never really rise. So yes, we get some wage rises pushed through because of what happened last year, but generally speaking, we don't see any evidence of sticky wages or wage rises or some wage price spiral, any of that sort. It's just not evident in any of the data. So now we've established that the economy is currently in recession. We think it was priced last year by asset markets, and therefore they are looking forwards. Our financial conditions index, which is 9 months in the future, has been going up for a significant period of time. That calls exact timing of the low in the ISM. The markets exactly followed suit. The liquidity cycle is driving. Here we are with a slow economy. Here we are about to see unemployment rising, non-farm payrolls falling, and inflation falling, and an ongoing deflation in core CPI. That is exactly the set of circumstances why I think the Fed was so late with the rate cycle this time around. Because they want these things to undershoot, because what they need to do is debase the currency to pay the debts.
Historical precedents of FED actions. The observation that the FED has historically cut rates when unemployment rises by 0.5% from its low since 1950 is significant. This pattern suggests that the FED uses unemployment as a key metric to gauge the health of the economy and adjust its monetary policy accordingly. Low unemployment doesn't equal high wages. The case of Japan is illustrative. Despite having a low unemployment rate for a prolonged period, wage growth has been stagnant. This challenges the conventional wisdom that low unemployment should lead to wage pressures due to increased demand for labor. Factors impacting wages. The transcript highlights the role of an aging population, offshoring, and technological advancements in suppressing wage growth. As older workers retire, younger workers, despite being employed, face competition from global labor markets and automation, which can keep wages in check. Lack of sticky wages. The absence of sticky wages, or consistent wage growth, even in low unemployment scenarios, can have broader economic implications. Without substantial wage growth, consumer spending might be constrained, which can impact overall economic growth. Financial Conditions Index and Liquidity Cycle. The mention of the Financial Conditions Index suggests that there are forward-looking indicators that can provide insights into future economic conditions. The alignment of this index with market movements underscores its predictive power. FED rate cycle timing. The assertion that the FED was late in its rate cycle decisions because it wanted economic metrics to undershoot is intriguing. If true, this suggests a strategic move by the FED to debase the currency, making debts more manageable in real terms. Check out the video on screen now for more crypto news.